So let's jump right into it. And by the way, I just want to thank the good people at Real Traders today for putting together this event. They always put together the best events. They are amazing, great speakers, as you've already heard, every single one of them. And I just love being part of this. It's a real fantastic opportunity to come and without having to travel across the continent like I used to have to do in the old days, back in the days of yore, to go hear great trading speakers and professionals. We can just get on our computers, and it's, you take it for granted. I think a lot of you, especially some of you young whippersnappers, probably take it for granted, but at 56 and having been a trader since I was 8, my dad was a stock trader, and he started trading or teaching me when I was 8 years old. So 56 minus 8, yeah, you get it. That's right, that many years, that many decades. We didn't even have computers back then. In fact, when my dad started trading, he was 18. He traded for 70 years before he passed away, God rest his soul. And when he started trading, he'd go down on his lunch break to the local brokerage firm, sit down in the public room there, and there was a whole series of chalkboards. And there'd be a guy with a piece of chalk in one hand and an eraser in the other, and he'd be going down there and he'd write the latest quote, and then he'd go to the next stock, he'd erase the previous one and write the new one. Go to the next one, erase the previous quote, write the new one with a piece of chalk, and that was their time in sales. So fortunately, I never had to do that, but he would tell me that story, and we've come a long way since then, baby. Wow. Okay, so anyway, the markets have changed a lot over the last 4 decades, and it makes a difference in how the markets move. So today we're going to talk about how to trade with complete confidence day in and day out. And this is a timely webinar. This is updated for what's going on now and how markets move today in today's computerized environment. You heard an introduction already, so I won't go and repeat all of this, but I did just come out with a book called Trend Trading for Dummies, and that, of course, is published by Wiley Publishing Company, who publishes the famous Dummies series, and that's a brand new book, just came out a couple months ago. Received Reader's Choice Awards from Stocks and Commodities magazine now for many years. I've been featured in other books, work a lot with various brokers and exchanges and software companies, and have produced a lot of products for them, and done a lot of training for exchanges and other companies. So there's just a few. You can read my full bio if you'd like at topdogtrading.com. I'm sure you've seen a lot of these legal disclaimers, not only today, but every time you access your software or your brokerage account. And the problem with that is, it's great that we're required to do this, but I think people become numb to it because they see it so often. And yes, I put this up here to cover my butt. Yes, I do. But, no pun intended, these legal disclaimers are really more than just that. And so I like to spend just a little more time, and we're not going to spend a lot of time on this because I know you didn't come for this, but this is very important, that you need to really, really pay attention to these legal disclaimers, because this is the anti-hype stuff, all right? And there's way too much hype in the trading world these days. And that really saddens me because, like I said, my dad's profession, well, he actually was his avocation for trading, but he made more money trading than he did from his regular job. And I'm a professional trader, and so we take this very seriously, and we take offense when people make it sound too easy or, make get rich quick promises, because they're just not they're not realistic. And you need to be realistic when you come into trading, and therefore that's why I say these legal statements are actually where your education begins. Not just legal, it's education to help you be realistic. And so the fact is, trading is just simply not suitable for all people. Hey, no profession is suitable for everybody. Also, some markets are leveraged, and that's a two-edged sword. Talk to your broker. They can look at your account, what markets you trade, what kind of margins made available to you, and they can tell you what your maximum risk exposure is. That's what you want to know. Along with the risk exposure, you should only be using funds you can afford to lose. And so please, dear Lord, do not trade with money that you need for your house payment, your car payment, your kids' college education, or your retirement. Trading's too risky for that. Only use what's called discretionary money. All information in this presentation is for educational purposes only. I'm not going to give you any specific buy or sell advice here today. And the use of this information is entirely at your own risk. It's for general purposes only, and we assume no responsibility or liability for errors or omissions. All right, now, my lawyer's not here today, but I'm sure if he was, it would be the one time in my life I would ever see him smile. So now that we've made him happy, let's move on. Let's get a little feedback here. I've noticed in the previous presentations that you guys are really good at give and take of giving feedback, and I love that. So I want to customize this presentation for you a little bit today. Obviously, I'm using PowerPoint, so the presentation's already pre-written, but I can customize it in this way. And before I explain that, let me go ahead and just post this question here and have you start answering it in the question box. What are your most common trading problems, struggles, and frustrations? Go ahead and type those into the question box about what you're struggling with the most, or what your biggest problems are, what your biggest frustrations are, you know, just any of those things. Go ahead and type those into the question box. And here's how your answers will allow me to customize the presentation. So I can't create new slides on the fly, obviously, but when I come to certain topics in the presentation today that align with what a lot of you have said are your problems, I'll slow down and I'll spend more time on that topic. And if there's a topic in my presentation that none of you have mentioned is an issue with you, or not a problem, you're not struggling with it, then I won't spend much time on that slide at all, and who knows, I might even just skip some slides. So in that way, I can more customize the presentation for what your needs are, what you're looking for, and what would help you in your trading. So let's see what we got here. Oh boy, the print is really small. After all these years of staring at monitors, my eyes are not what they used to be. All right, but I think I can make out some of these here. So, being wrong, losing money, lack of consistency and confidence. Okay, very good, thank you. Discipline is another one. Adjustment on closing day. Direction. Always getting stopped out. I'm just reading the lists here that people are writing in. Holding losers too long and selling winners way too soon. Okay, good. Entries. Deciding position size. All right, very good. Over trading. All right. Futures. Okay. Exit strategies for stocks. Whipsaw, market direction. Better entries. Fixing one technique. Oh, I'm sorry. Again, that's my fault for having bad eyes. Finding one technique to rely on. All right. Rate timing. What to buy, what instruments to use, when to enter and exit. Basically everything. Okay, Michael, everything. Well, that's a problem, but you're a newbie. Okay, well, that's fine. We all start there. We all start there, my friends, so don't worry about that. You'll learn. You'll get it. You know what? That's the thing. When you're new, you got to learn everything. So no problem. You're at the right place. You're starting at a good place by being here today. Okay, next one. Stops when trading options stocks. Oh, yeah. Okay, so where to place your stops when you're trading options, I understand. Getting taken advantage of by market makers. Too much volatility in the markets for swing trading. Interesting. Slow to recognize setups. Okay, discipline, another one. Another one. I am new here and there's too much information. How do you sort through it all in order to create a trading strategy? Yes, Michelle, I do understand that. A lot of people have that too. It's kind of overwhelming, isn't it? There's so much information available in the markets, so many different approaches to trading. It gets overwhelming, and you are correct. You really do have to, at some point, just focus down and say, okay, well, this is going to be the game I play. I'm going to focus on just these few things, and every trader eventually does that. So I want to tell you, at least you're thinking along the right lines. That is what you have to do eventually, because there's just too much information to consider it all. It's impossible. Next one, using one strategy with specific rules that works and does not require me to be glued to the market all day. Oh, okay, well, that's certainly possible. Fear of loss and best strategies to book profit, all right? News always sabotages my trades. Yeah, news is very important. And there's an old saying that is news trumps technicals. And I think that's the problem that you're experiencing. Okay, and there's more, but you know what? We're getting a lot of the same answers here now, so that's fine. And that just actually, everything that you're putting here really reinforces what I have found, because I have taken and done polls of traders and asked them this question, and literally tens of thousands of traders I've polled over the years. And here are the most common answers that came up. I kind of worded them so that they would cover the general areas that people were talking to. So see if these make sense to you. I think they will. Given the answers that I've read from you individually, these are the most common problems people had who were polled. Number one, people would say, and by the way, these are not in any particular order. These were just the top ones. So the first one, though, I've got here is people would say, well, I enter the market. Say, for example, they buy. They're going long. And then as soon as they get in, the market turns around and stops them out. Then, right after they get stopped out, the market turns back around and goes in the original direction of their trade. So that's a timing issue. They just got in a little too early. Getting out of big moves too soon, and so not making the huge profits. Several of you, in fact, quite a few of you mentioned that. Getting stopped out too often. That's another one that quite a few of you mentioned. Getting stopped out too often. Where to place your stops. That also kind of goes along with that one. Whole issue of stops. Your first stop, your trailing stops, all of that. That whole topic. Not knowing the best place to exit the market. Again, this is one that a lot of you listed there, so very common one. Trading a trend that doesn't follow through. And again, this is one that a lot of you listed. Anyone who has said direction, you're talking about trend. And sometimes here's a question. How do you know when a trend is, this is actually kind of a little inside joke with traders. How do you know when a trend is going to end? The answer, right after you get in. Okay. But it seems like that, doesn't it, sometimes? It's like, yeah, how do I know when this trend? I can sit there and wait and wait and wait and say, I'm not sure if it's confirmed yet, if this is a good trend, if the trend's going to continue. And then finally you decide to get in, and that's exactly when it ends, and it turns against you. So that's a key issue, trading a trend that's going to follow through after you get in. That's really the key. Anybody can look at a chart historically and see, oh, we had a trend. Yeah, big deal. That doesn't make us any money. You're not a genius to be able to do that. What we really care about is, will the trend continue after we get in? And for so many people, it doesn't. And that's a problem, obviously. So we're going to help you with that problem today. So what I'm going to share with you today is an overview of my entire trading methodology. And so I would actually encourage you to have a pen and paper handy. You don't need to have your wallet or purse handy because I'm not selling anything today, so you can put those away. Just have your pen and paper handy, and I do have some free stuff for you at the end, but I don't have anything to sell you today. That's my fault. I should, but I don't. So anyway, you can breathe easy and just take the free stuff. All right, and we do have some free bonuses for you at the end. No purchase required or no purchase even offered. You can buy anything from me today if you wanted to, so how's that? Okay, so my trading methodology is all about one thing. And everything I do is very, very simple. Like I said before, you'd have to sort through all the information in the market, and I think it was Michelle who talked about that, being overwhelmed and too much stuff. And she's 100% right. You've got to just focus on a few things. Claim your stake to what game you're going to play, what part of the market game you're going to play. And so here's what I do. I only trade looking at 5 what I call energies in the market. 5 energies. Now, when I talk about energies, what I'm talking about is the energy of the flow of money. I'm very practical when it comes to trading. Everything that I do, even with technical analysis and everything, I understand that there's a market logic behind it. I'm not one who believes in, esoteric mysteries of the universe and parallel universes and magic numbers and all this kind of stuff. Sorry, I'm not putting that down. I'm just saying that's not my thing. That's not what I do. Now, do I trade Fibonacci and that sort of thing? Yeah, I do. But to me, there's a logic to that. There's not any esoteric mystery to Fibonacci. There's an actual logic, and I actually have a webinar on that too, and I show you why Fibonacci numbers work, and it has nothing to do, by the way, with the structure of natural material physical objects. But there's a logic to it as to why it does work. Everything I do, all the indicators, there's a logic, a market logic to why they work. So I call my approach to trading a methodology because it's very methodical, meaning it's rule-based, it's objective, based on black and white rules, and there's no subjectivity or discretion involved. And it's very orderly. So, again, to keep my mind straight, to avoid getting overwhelmed mentally, I look at a chart and I look at it the same way every single time. And I look for these 5 energies in the exact same order every time, again, to keep my mind orderly, to keep myself, to avoid confusion and maintain confidence and clarity. Okay, so let's list these 5 energies. The first energy I look for is the energy of trend or direction. And again, I have an instrument or an indicator that measures all of these energies for me so that I don't just look at a chart and say, oh gosh, it looks like it's going up, or well, no, this looks like it's going down. That would be too subjective or discretionary. So I do use indicators, but I don't believe indicators make you any money. Indicators do what they promise, which is what? Indicate. That's all they do. Hey, if indicators made us money, we would call them money makers, but we don't. We call them indicators because that's what they do. They indicate, but they do not make you any money. I actually prefer to call them instruments because each one measures an energy in the market. I see them, and when I talk about an instrument, I'm referring to having like instruments on the dashboard of your car or in the cockpit of a plane. So let's take the plane analogy. I've got a friend who actually owns a little private plane, a little 4-seater, and I've gone up there with him many times. And, he's been flying for decades. So he can look out the window and he can tell basically roughly how high he is and what the tilt of the wings are from left to right and the angle from the toe to the tail or from the nose to the tail. And that's cool. But if he looks at the instrument panel, he's got an instrument panel or an instrument for each one of those things, the speed, the altitude, the tilt of the plane, and they will tell them exactly what those are, an actual value. And that's how I use indicators. Let's face it, that's what an indicator is. It's just a mathematical formula. You put some numbers in one side and it pops out a value on the other side. And that value is the objective measure of an energy. So, for trend, I've got an instrument that measures trend and it gives me a value so I know the exact value of that energy. Okay, after I look at trend, let's say it's up. Okay, so then that's the first thing is I'm looking to potentially go long. I will never trade based on direction alone because trend by definition is always a lagging indicator. It only tells you what the market's been doing up to this point in time. And again, that doesn't help us for after we get in. Then we go to energy number 2, and that is the energy of momentum. Now, momentum refers to the strength of the trend. So there's 2 types of trends, strong trends and weak trends. We only want to trade strong trends because that's what helps to give us a probability that the market will continue in the direction of the trend after we get in. Now, momentum by its very nature is a leading indicator. Trend is a lagging indicator, and so we have to use it with momentum because momentum is a leading indicator by nature. Why do I say it by nature? Well, think of a locomotive, a train going down the track. If a train is going down the track, say at 60 miles an hour, it will take it about a mile to stop. So from the time you pull the brakes, it's going to take about a mile for that train to stop, meaning that when you pull the brake, you know that train is going to keep going in the same what? Direction after you put the brakes on for about a mile. It's a leading indicator in that way. And in trading, that's what we want. Even if the brakes are put on, we want to know that after we get in, the market will make at least one more higher high if we're going long. Okay, then the third energy, let's say we have a trend that's up, and let's say it's strong. Okay, great. But now timing comes in. When do I enter that trend? And this is where some of you have said, and the people in the poll said too, that they would get into a market, but then the market would stop them out, and then it would go in the direction of the original trade. What happens there a lot is, let me bring my freehand tool up here, and I'm definitely not an artist. Okay, so let's say the market's going up and you get in here. All right, and that's great. It makes a higher high. That's cool. And then the market's going up and it's making higher highs, higher low, and you get in here. Okay, that's great. You get filled, but then the market doesn't make a higher high yet, and it goes back down, and you get stopped out because you placed your stop below that low. And then the market goes and takes off. This is the problem with timing. This actually is called an A-B, oops, told you my freehand is really bad, ABC complex retrace. So the point is, we don't want to get in here. We want to wait till that final cycle low, the lowest low between the two waves, so that we don't get stopped out. And then we want to know where to place our stop. Okay, so it's timing, right? There's two axes on a chart. Price. Most things in trading are based on price. Very few people actually used time. Very few people actually have a good timing indicator and know how to use it. But there's only two aspects to a chart. It's a two-dimensional object, price and time. So if you don't have some great timing tool, you are literally eliminating 50% of the information on a chart. And how can you establish a probability scenario if you're only using 50% of the information? Well, you can't. So anyway, that's why cycles are so important. And that's where cycles come in, is when do I get in? Just because I've got a trend and it's strong, that's not enough information to trade, because I can still get whipsawed out. Okay, and then the fourth energy is support resistance. And I'm going to speed it up here a little bit because I'm a little slow, a little behind, and I want to make sure we get done on time. Also, I see some questions coming in, but I'm going to have to wait to answer those till the end so that we make sure we get done on time. Support resistance are a blockage of energy above or below. So if we're going long, we want to buy off of support. If we're going short, we want to short off of resistance. And we also use support resistance levels as profit targets. And then finally, the fifth energy is what I call the fractal energy, and that's just a fancy name for using multiple time frames. So this is a common practice if you're using it, let's say you're trading off a daily chart, then I would look at a weekly chart of the same market, and that would be called my fractal energy. Same thing, just a different scale. If we're doing intraday trading, if I was using a 5-minute chart, I would use a 15-minute chart for my fractal energy. When I trade E-minis, I like to use a 1,000-tick chart, and I use a 3,000-tick chart as my fractal energy. Now, I do it a little differently than most people do, and if we have time, I'll tell you how I do it a little differently. So as I mentioned, we use instruments then to measure each of these energies so that we're not being discretionary or subjective in our determination of what those energies are. So the energy of trend we measure with a moving average, specifically the 50-period simple moving average. For momentum, we use a momentum indicator. For cycles, we use an oscillator. For support resistance, I use things like the previous cycle high and low, the previous wave high and low, Fibonacci levels, floor trader pivots, 52-day high and lows, things like that. And for the fractal energy intraday, I always use a 3-to-1 ratio. So again, if I'm using a 5-minute chart as my setup, then use a 15-minute chart as my confirmation chart, my fractal energy chart. So what are we doing? Why are we measuring these 5 energies? We're measuring these 5 energies specifically to determine a probability scenario. In fact, that's really what trading is all about. All trading comes down to, no matter what method or approach you're using, is to determine a probability scenario. And there's many different ways to do that legitimately. But the way I do it is at each potential entry point that I'm considering, I ask myself one simple question. How many of those 5 energies are aligned, all being bullish or all being bearish? Based on that, I get a setup of a score of 1 to 5. Obviously, the higher the score, the higher I consider the probability of success. I liken this to taking each trade to court. And what I mean by that is I need 5 independent witnesses to establish a preponderance of the evidence. Now, the operative word in that sentence is independent. Independent witnesses, that's the key. You couldn't get the same results if you put, say, 5 trend indicators on a chart. Because remember, those indicators, they're just instruments and they measure in energies. The energies we're interested in, not the indicators. The indicators only serve to give us an objective value for the energy. So if you were to put 5 trend indicators on a chart, that doesn't do the same thing because they're all measuring just one energy, and the number 1 does not give you a probability scenario. You need a number of independent variables to put together to create a probability scenario. So we want to measure 5 independent energies. And that's what we have here. That's why I use these 5. These are all uncorrelated, or I should say each one is uncorrelated to the other 4. So just a quick example. Let's say the market's trending up. So if price is trending up, sometimes you'll look down at your momentum indicator, and the momentum indicator is also trending up, meaning that momentum is bullish. Well, that's great. Then at least those 2 energies are aligned. They're both bullish. Other times you'll see prices trending up and momentum is just flatlining. It's just at the 0 line, just going flat. Well, then that is not a strong trend. Those 2 energies are not aligned. Other times you will actually see price trending up and momentum trending down, going in the exact opposite direction of price trend. Well, how can price be trending up and momentum be trending down? Well, let me tell you, it's actually quite common. It happens all of the time. It's not unusual. So that's because those 2 energies are not correlated to each other. They can do completely different things, and they do completely different things all the time. Now, that's just an example of those 2, but that's true of each one of these 5 indicators. And that's what makes it significant, and that's what gives you a probability scenario when all 5 of these energies align, being bullish or bearish. Okay, so now we've talked about the concepts, the words, you've got the basics of the system. Now let's actually take a look at some examples. And we're going to go through the 5 energies again one by one, and I'm going to show you the instruments that I use to measure them and just show it to you visually because technical analysis is a very visual thing. So energy number 1, trend. I use the 50-period simple moving average. And the 50-period simple moving average is used for a couple of reasons. Number 1, it's a very common moving average, and that's a good thing. Some people think, oh, that's bad. You should use things that nobody else uses. No, you want to see what other people see. Remember, most people lose money trading. So you actually want to see what other people are looking at. Also, trading is really a big, huge, massive auction house. So you want to see what other people are going to be responding to. And people respond to the 50-period simple moving average, especially on daily charts, daily, weekly, and monthly, more so than intraday even. But if you're trading off of daily, weekly, and monthly charts, then 50 MA, absolutely. So one thing is it has a self-fulfilling prophecy to it just because so many people use it. The other thing is it fits the definition of trend. Well, what's the definition of trend? Webster's Dictionary defines trend as the extended general direction of the market. Okay? And there it is, to extend in a general direction. That's what trend means. So you can't use a short-term moving average or a short-term indicator to measure trend. By definition, you can't. It measures the extended general direction. And so 50 MA happens to meet that definition. So some people say, well, the trend is higher highs, higher lows. That definitely has a place in trading. But for example, here we have a higher low and a higher high. Is that the trend of the euro here? Well, it is not the extended general direction of the euro. The 50 MA angling down, that is the extended general direction of the market from a high to a low. So that shows the downtrend. This higher low and higher high, that's just a complex retrace against the trend and actually provides a great short entry either here or here. So that's one thing where some amateurs who will actually take that as a long signal, you can trade against them. And that's usually a pretty good way to make money, is trading against what amateurs are doing. Okay, that's energy number one. Now let's move on to energy number two, momentum. Momentum is the strength of the trend. And as I said, momentum is a potentially leading indicator. So we've got higher high, higher low, higher high, higher low in price. Now, 50 MA is angling up, but remember the trend indicator is just the trend indicator. It indicates, it doesn't tell, and it is lagging. By the way, I remember one of my teachers telling me, make sure you always have a lagging indicator on your chart. And in fact, he was my first major teacher after my dad. And I thought he was literally out of his frickin' mind. What? Why would I ever want a lagging indicator on my chart? It just seemed stupid to me. And I never even understood it while I was under his tutelage. But later on, I remembered words he said, and as I got more experience under my belt, and I started to get it. And basically the rough, just general Reader's Digest answer is lagging indicators tend to be more accurate because they require more information before they give you the signal, and therefore they tend to be more accurate. Leading indicators, yes, they give you an early indication, but they tend not to be quite as accurate. So with my method, I put the two together. Leading and lagging indicators I always use together, and that way I get the best of both worlds. All right, but anyway, so here's the question. If we bought here, that would be great. Higher high, higher low, we make a much higher high. But how would we know to buy that low but not buy this second low? I mean, we've still got higher highs, we've still got higher lows, the 50 MA is still angling up. The problem is with the information shown on the chart, you wouldn't know not to buy this next higher low because momentum is blacked out down here. We can't see momentum. I've hidden it. We need momentum. So here, for example, higher high, higher low on price, higher high in momentum, higher low on momentum. Okay, then we go to our next high on price. And what's momentum doing? Equal high. Oh, that's our first tip that, wait a minute, there's a momentum shift. Yes, the market is still moving up in direction and in price range, but it's moving up on not on the same amount of strength as the previous impulse move. Then a lot of people look for divergences like this, but what they don't do, they'll just look for the divergences on the high and they forget to look at the lows. Very important to look at the lows as well. So we've got a higher low, but momentum is putting in a lower low. And that is your death blow right there. That's the nail in the coffin. Now momentum is not only making a lower low, but it's gone to a value of what? 0. There's no momentum left in this market. No strength to the upside or even to the downside, really. It's negligible. And that's what would give us the indication of saying, wait a minute, momentum being a leading indicator is saying, yeah, at this snapshot in time, if that's the hard right edge of the screen, price is still literally in an uptrend. So the 50 MA is not wrong in the sense that at that snapshot in time, we are in an uptrend. But what we're concerned about is what's going to happen after that, after the break is pulled. Now we put in, momentum gives us a leading indication of that, and then we put in a lower high. Now, this is a great place. Again, amateur traders will look at this and they'll buy that. And again, trading against the amateurs is usually the right thing to do. And they don't see this. We see this. This is invisible to them. It's visible to us. You've heard that you need an edge in trading. I call this an invisible edge, something other people don't see. So I would actually fade to this trade. Instead of trading with the trend, now I'm going for a trend reversal. Now you have three choices. You can either do it here. That's a rather aggressive trade because really momentum is just zero here. There's no indication of that there's going to be a downtrend yet. So that'd be an aggressive trade to take. You could do it here. That would be another rather aggressive trade. The most conservative short would be here. And the reason is twofold. Number one, we're under the 50 MA for trend, and momentum is staying below the zero line, meaning that momentum is now bearish. And you've got a nice candlestick pattern there as well. Okay, let's go to energy number 3. Energy number 3 is cycles, and cycles are the rhythm of the market. They're like the respiration of the market, the inhale, the exhale. Markets don't go straight up or straight down. They kind of wiggle up and wiggle down. As I said, the chart has two dimensions, time and price. Most people don't do anything with time, which is ridiculous. Of the two, not only are you missing out 50% of the information of the chart, W.D. Gann said that time is more important than price. So you're actually missing out on the more important of the two dimensions. When to buy, when to sell. Okay, energy number 4, support resistance. As I said earlier, that is a blockage of the other energies. Now, again, you cannot trade with any one of these energies by themselves or any one of these indicators by themselves. With support resistance, for example, hey, and if you've been trading at all, you know this, sometimes price will just fly right through a support resistance level like it wasn't even there. Just cut like butter. Other times, it goes to a support resistance level and bounces off of it. That begs the question, well, how do we determine which levels the market will bounce off of and which levels will the market just fly through? Answer, based on support resistance alone, you don't know. It doesn't tell you that. There is zero indication on support resistance alone of which level will hold and which level will not hold. You need to look at the other energies. You look at whether there's strength moving into that support resistance level, then it'll probably slice through it. Or if it's moving on weakness, then it probably won't. That's just one answer. So let's look at this example. Let's just go to the second example here. So now we've got price coming up. So what we're measuring, by the way, is from that high to that low, we've drawn our Fibonacci retracement levels. So there they are, 0, okay, 23, 38, 50, 61, 76, and back to 100% retracement. Okay, so let's look at this level. How would we determine that this blue line here, this resistance level, is likely to hold and the market will likely bounce off of it? See, it didn't hold the 38 below it, did it, at all? It didn't show any resistance to it at all. Just sliced right through it like it's not even there. So here's how we would determine that that level is probably going to hold, the market will go down. Number 1, it is a cluster of resistance. What's the cluster? It's 2 levels of resistance. One is this high, this wave high, that creates a resistance level. The other one is the 50% retracement from that high to that low. Now, why do clusters work? Remember I talked about market logic? People talk about clusters and they say, well, think about them as a double thick wall and all that kind of stuff. And that's good, you know, thinking of it that way is helpful. But they don't work because they're a double thick wall. They work because different people, different traders are looking at different levels. Some will see that high. Others will have drawn a Fibonacci retracement from there to there. Others may have drawn it from a different high to a different low. Point is, the more resistance levels you get there, the more market participants are seeing it and responding to it and trading off of it, either going short off of it or taking profits into it. And that's why clusters are significant. That's why they work. You simply have more traders responding to the levels. So that's number one. Number two, we've got an engulfing candlestick pattern high. Okay, again, that by itself meaningless, but even as Steve Nissen says, candlestick patterns need to be understood in the context of the entire chart. He's 100% right about that, and that's what we're doing. We're putting it in the context of the rest of the things on the chart, but it's one piece of evidence. Now, what's the trend? The trend is down. 50 MA, the red line, is angling down. Even though we're above it, the 50 MA is still angling down, and therefore we're still in a downtrend. So direction of this market is to the downside. Then we look at our timing indicator. Our timing indicator has peaked and has turned red and is turning over, meaning it's time to put in a high. So it's time to put in a high in a downtrend, in a double resistance level with an engulfing candlestick pattern. And is there strength or weakness going into that resistance level? Weakness. Here's our momentum indicator. When the market goes down, it pulls far away from the zero line. Far away from the zero line. When the market goes up, it barely gets above the zero line, meaning the bullish moves in this market are very, very weak. So there's not enough strength to break through that. Then when it goes back down, it starts pulling further away from the zero line again. Okay? That's how we use support resistance. And the final and the fifth energy is what I call the fractal energy. And the fractal energy is the longer time frame, the bigger time frame. And I like to use a 3-to-1 ratio. If we've got a 1,000-tick chart here on the left, then I'd use a 3,000-tick chart. And I use this chart as my setup, and this chart as my confirmation chart, I call it. Okay, so we look for a setup over here. The market's been meandering. It's above the 50 MA. It meanders below the 50 MA. So now we're kind of looking for the short side, but still it's pretty flat. And so we wait. And what are we waiting for? We're waiting for the energies to align. Well, the 50 MA also provides resistance. It also, we get a engulfing candlestick pattern high. At the same time, we get a cycle high on the indicator. At the same time, momentum is below zero. So that's all now come into alignment. Then we go over to our longer term chart. Now, a lot of people will say trade in the direction of the trend of the longer term chart. And that's okay. That can be helpful. I prefer to use momentum. Now, if trend is going down as it is here, that's fantastic. That's great. But remember, trend is a lagging indicator. So if you use trend, a lagging indicator, in a 3 times slower chart, then your signals between these two time frames are not very correlated with regard to time. There's not a tight correlation time-wise. Momentum, being the leading indicator, takes that slower chart and tightens up the relationship between its signals and the faster time frame. So therefore, for me, I like to trade in the direction of momentum of the longer term time frame, and that's what I use. If momentum were going up here, I would not take this trade short. It is a deal breaker for me. It is a filter. This setup over here on the short term chart can be perfect. I mean, this right now, this one's kind of a iffy one. You know, it's okay, but it's a higher risk trade because the breakout hasn't occurred yet. But if momentum were angling up, there's no way I would take that trade. Angling down is what gives me the encouragement to go ahead and take that trade. And in fact, I will only take trades where they are confirmed by momentum of the next higher time frame. That's a deal breaker for me. Okay, so let's put it all together and show you how simple my 5 energy method actually is. So here's the list over here, and this is all I do all day long. 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Now let me tell you that, well, let me go through this first and then I'll share that. So here's how it goes. We've got price going below the 50 MA. We've been in a downtrend. By the way, we only trade in the direct, I don't just have a trend trading method. We can trade against the trend too, as I indicated on that momentum slide. We have momentum trades where we intentionally trade against the trend. And the reason for that is that the trend is your friend until, well, you guys, I'm sure some of you know the answer. The trend is your friend until what? Until the fat lady sings, until your mama comes home, until until you get in. The trend is your friend until it ends. That's right. Yes, very well known saying. And Deborah and Ruben and Michael and Dave and Ripple, you guys all got that. Okay, till the baby cries. Yeah, till we cry, right? So that's right. So the trend is your friend until the end. Now, what that means is, I mean, in and of itself, that saying is kind of innocuous. It's like, well, okay, obviously. But the meaning behind it is that you have a higher probability of trading in the direction of the trend if you trade early in the trend. Now, again, my methodology is very methodical and rule-based, so every word has a very clear definition. So the word early in my method means the first two retraces in a trend. So I only trade in the direction of the trend in the first two retraces. After that, I either am just staying in the trade until we see a momentum shift where it looks like, okay, the trend's getting really weak, so I'll get out now, or we'll take a reversal trade, okay, as we did on that other example when I showed how momentum led trend. So first two retraces in the trend. So this trend down here has been going on for a while. So we're going to let it go and we're going to wait for a new trend. Price pops above the 50 MA for the first time in a while and retraces. There's our first retrace in a trend. I love first retraces in a trend. Not enough to take a trade, but that's a setup that I'm going to now consider. Now, what do we look at? So first of all, we're starting a new trend, energy number 1. Let's score this trade, 1 out of 5. 2, momentum. That's the second thing we look at. I look down here at momentum. On this retrace, momentum holds above the 0 line. See, there's the 0 line. And momentum is still very, very bullish, way above the 0 line. Therefore, momentum is bullish and direction is bullish. So now we have a score of 2. 2 out of 5, still not good enough to take a trade. Still not going to take the trade, but we're not done counting our energies yet. Okay, energy number 3. Cycle indicator comes down and turns up. Okay, so now it's time to put in a low. Okay, so that's energy number 3. We got 3 out of 5. Number 4, are we bouncing off of some sort of support? Because, see, we wait for retracements, but the way a trend works is you want a strong impulse in the direction of the trend, and you want a weak correction. So if that correction is weak, it should maintain bullish momentum and bounce off of support and not slice through major support. So this red line is the 50% retracement level, and that's a very significant one. So yes, it's bouncing off support. All right, we wait, make sure it bounces. Number 5, so we got a 4 out of 5 score so far on the setup chart. For number 5, we have to go to the longer term chart, the fractal energy chart. Now, here's the 50 MA. It's down. We're in a downtrend. Well, the indication is down, but that's a lagging indicator on a 3 times slower chart. So we're not concerned about that because the timing is not very correlated. It's not very tight. The best way I can explain that is there's a loose correlation. It's kind of like my first car when I was a kid in Detroit and I got a job and I had to get a car and couldn't afford much, so I got an old used car, and there was a lot of play in the steering wheel, meaning I could turn that steering wheel a few degrees right or left, but the front wheels wouldn't turn. Okay, so I had to really turn that steering wheel quite a bit. A few degrees right or left wouldn't turn the steering wheel, or wouldn't turn the tires. So that's the same thing here. So if you're measuring the 50 MA, it has a loose correlation to what's going on the longer term chart or on the shorter term chart. So instead, we go down to momentum, which responds much more quickly. And as you see here, trend indication's down, but momentum indication is up. They're in opposite directions. So we only use the momentum indicator to confirm our trades on the shorter time frame. It's angling up, and that angle is nice and dramatic. And therefore, yes, that confirms a long trade here. And that's a 5 out of 5 trade. And that's as simple as it is. So let's summarize, and then I'll see if I have time to answer a few questions here. All we're doing is we're waiting for the alignment of the 5 energies to put the odds on your side. And here's my method in 1 sentence. I know. I went out to, I won't even mention where I went, but I was invited by one of the biggest trading clubs in the country to go and speak. And so I did, and it was a wonderful experience, great people. Some of the inner circle invited me to dinner, and they were proud that they were working on their own trading system. And they brought it along, and it was up to, they weren't done with it yet, but it was up to about 250 pages. And they were very proud to show it to me. They plopped it on the table, and water went spilling all over the place. And I thought, wow, well, that's an impressive amount of work. I don't know, it would take me a year to read this thing, let alone learn how to implement it. But anyway, you know, for me, simplicity is always the best. And when one of my mentors was a floor trader at the Chicago Mercantile Exchange, and I flew out to Chicago, rented an apartment out there, and worked with him for a while. And when I was on the floor, you know, you really feel and sense the energy of the market. And you realize that as a screen trader, we can get caught up in all these wiggles and jiggles and lines and dots and think that's the market. That's not the market. You know, technical analysis to me is just a map of mass psychology. That's all it is. It's not the thing itself. It's just a map of it. Get down into an exchange floor and you start to feel that energy, and literally you can hear the energy up or down, and you can simulate that somewhat by subscribing to a Squawk Box, but it's still not quite the same as being on the floor and seeing where the orders are coming from, although obviously they try to hide their, cover their foot tracks, and they do very successfully, by the way. But anyway, you know, there's only so much you can do. We're doing probabilities here. And so my method comes down to one sentence. And it's always, again, in this order to keep my mind orderly and clear, never confused. In fact, one of my rules is if on any one of these energies you're not absolutely certain what the energy is, then you pass on the trade. We always default to pass on the trade until it's absolutely clear and certain. Then we take the trade, because we know that over a large sample of data we'll come out ahead as long as we're trading it accurately. So we trade in the direction of the trend early in a new trend. Make sure that trend is strong with the energy of momentum. At the right time, waiting for our cycle indicator to indicate when to get in, with support at your back. Obviously, if you're going long, if you're going short, then we use resistance. And then confirm it by the bigger scale, and the bigger scale is always looking at the angle of momentum on the longer time frame. So the method's very robust, very adaptable. I use this same energy for stocks, commodities, options, currencies, futures. I use the same 5 energy method for investing, swing trading, day trading. And a lot of people ask me about that. They say, well, how can you use the same method for all these markets and all these time frames? And not all methods are designed for that. Some are designed for specific markets and time frames, and that's fine. The reason this works for, it's so robust and adaptable, is because, remember, it's just like taking a chart. In fact, actually, it's not like, this is what we're doing. We're taking a blank chart, and then we're putting these instruments on it, kind of like a speedometer, tachometer, odometer, right? And you're just putting the instruments on there. And then no matter what market you put on and what time interval you put on there, those instruments will measure the energy it's designed for of that market and of that time frame. It's just like a speedometer. It doesn't matter if you put that same speedometer in a Ford or a Ferrari. It's going to measure the speed of the car. So it's a very simple and objective method. We're simply counting to 5. So here's the, I told you guys I was going to give you a free offer today, and just some freebies, and that's what I'm going to do. Nothing to sell here today. So here's what you get. You get my free 5-day video correspondence course, and you'll get the very first video today. Each day, over the next 5 days, you'll get another video. It's about 15 minutes long, and each one teaches a lesson, and the lessons are designed around really what a lot of people have learned, a lot of the traditional technical analysis, and why it doesn't work anymore. Because a lot of traditional technical analysis that's even taught today is based on old orthodox things that, you know, they worked back when they were created, but now the markets move differently because of logarithmic trading, high-frequency trading, the massive access that retailers have to the markets. That's changed the way the markets move. Markets move differently now than they have before. and adjustments need to be made. And that's what this course is about. What works now? At the end of each lesson, there's actually an interactive multiple choice quiz right on the video. Nobody else sees it except you, but it makes sure you got the information correct. The fourth video, I share with you one of my favorite trade setups called the rubber band trade. And I take that trade every time it sets up, even to this day. So that is a great trade, a very high win-loss ratio. It's not a big reward to risk ratio. It's not a trend trade. It's a little scalp trade, but boy, winner after winner after winner after winner. Get all these little winners adding up, and believe me, it makes a big difference. And then also finally, you get my personal cycle indicator. I'm sure one of the questions that's probably coming through, although I haven't looked yet, is, well, what exactly are these indicators and everything? So I will be sharing with you my personal cycle indicator, exactly what it is. What it is, it's a modification of a traditional indicator. But then just having that still isn't enough, so I will teach you, give you a tutorial on how to trade it. Just like with price. Price has patterns like head and shoulders, triangles, wedges, and so forth. Indicators have patterns too. And so there's certain patterns that we trade on the cycle indicator, and if those patterns don't show up, we ignore it. We wait for those patterns. So that'll all be shared with you as well. Okay, all that stuff for free. Just go to www.realtraderswebinar.com/topdog. And in fact, I see Kevin has posted that in the chat box, and that is a clickable link. So you can just click on that and get all that free stuff. So unfortunately, it's 1 minute past the top of the hour. I was hoping to have a little time for Q&A, but I ran 1 minute over. So my email is up there, Barry@topdogtrading.com. So if you do have any questions, feel free to email me, and I'll be very happy to answer your questions that way. All right, so thank you everybody for being here. You've been a great audience, and thanks to Kevin and everybody at Real Traders Webinar for hosting this event today and for inviting me. I've really enjoyed it, and I hope you have as well.
Barry, thank you so much. And guys, again, if you would like to check out Barry's free video course, the feedback on this has been amazing. Every time we have Barry here, we always get great feedback on that free course. Definitely check it out. And Barry himself, we always get the best feedback from. So Barry, thank you so much for being here. And we also want to say thank you to all of you for being here.